When people hear market crash, they picture catastrophe, accounts plunging, headlines screaming, and years of savings evaporating overnight. But that's not the whole story. Behind every panic, there's something else happening in silence. Ownership is shifting. Assets don't vanish. They change hands. History shows that after every major financial collapse, a small group walks away owning more businesses, more property, and more income streams than ever before. The difference isn't luck, it's preparation. As we move toward the mid-2020s, the real question is simple. When the next reset hits, will you be among the panic sellers or the strategic buyers? We've been trained to see a crash as pure ruin. Lost jobs, failed banks, and broken retirement plans. That's all real, but it's not the full picture. Under the chaos, something much more strategic is happening. Wealth is not being burned, it's being reassigned. Stocks that once seemed untouchable suddenly trade for a fraction of their former price. Real estate that was too expensive forever becomes available at distressed levels. Entire companies, brands, and assets quietly move from people who were over-leveraged and emotional to people who were liquid, patient, and prepared. In the 1930s, in the early 2000s, in the late 2000s, each time the pattern repeated. Millions suffered, but a small minority used the same event to massively expand their ownership of real value. They didn't do it because they enjoyed suffering. They did it because they understood one uncomfortable truth. Markets are emotional, but value is not. When fear spikes, prices disconnect from reality. A crash feels like the end for those caught off guard. For those ready with a plan, it's the moment the entire game board quietly resets in their favor. Financial crises often look like freak accidents, but a longer view tells a different story. Economies move in waves. Long stretches of growth, cheap money, and rising optimism naturally invite risk. People borrow more, stretch further, and assume the good times will last just a little longer. That mindset shows up every cycle, right before things snap. Over many decades, you can see a rhythm. Periods of easy credit and booming markets, followed by painful resets where reality reclaims control. Debt that once seemed manageable becomes suffocating. Asset prices that floated far above fundamentals come crashing back to earth. The crash feels sudden. The buildup never was. Right now, as we move toward the late 2020s, many of the familiar ingredients are back on the table. Elevated valuations, historic levels of borrowing, and a deep belief that central banks will fix it no matter what. That belief has been tested before and eventually failed. You don't need to predict the exact day or month of the next break. You only need to recognize that we're not in a unique era, immune from cycles. We're in another chapter of the same long story. Expansion, excess, correction, opportunity. Crashes aren't announced in advance on TV. They're whispered first in the numbers. You see it when stock prices soar much faster than company earnings, when valuation metrics drift into territory that previously preceded big declines, when households rely more on credit cards and loans just to keep the same lifestyle, when corporate debt piles up on the assumption that low rates will last forever, when government deficits balloon with no credible path to restraint. At the same time, small cracks appear. Manufacturing activity slows. Businesses delay hiring. Commercial properties sit vacant longer, and delinquency rates inch higher. None of these alone scream collapse, but together they sketch a picture of rising stress beneath the surface. Meanwhile, the public narrative tends to stay calm. Official forecasts talk about soft landings and temporary headwinds. We've heard that language before previous downturns. And just as before, the largest and most experienced players often act very differently than they talk. They raise cash. They reduce exposure to the frothiest assets. They quietly shift into areas that historically hold value when volatility surges. The message is clear. By the time the average person feels something is wrong, the patient investors have already moved. To most people, a crash is a nightmare. To seasoned investors, it's a familiar storm they've been quietly preparing to sail through and capitalize on. They don't rely on hope. They rely on history and math. They know that long bull markets breed overconfidence, and that overconfidence leads to overpriced assets and dangerous leverage. They also know that eventually gravity returns. When that happens, those who borrowed too much and chased too hard pay the price. Wealthy, prepared investors think in decades, not days. When markets are euphoric and everyone seems brilliant, they get cautious. They trim risky positions. They build a cash buffer. They study which companies, sectors, and properties they want to own more of, but only at better prices. Then, when fear spreads and "this time it's different" turns into "this time it's over," they don't join the panic. They execute. They buy quality businesses at distressed valuations. They acquire real estate no one could touch a few years earlier. They take over assets from forced sellers. They're not immune to losses or volatility. They simply understand that crisis is not the end of the story. It's the chapter where patient owners quietly upgrade their spot in the system. In calm markets, leverage makes people feel powerful. Borrowed money amplifies returns, boosts confidence, and convinces many that they're financial geniuses. But in a sharp downturn, leverage doesn't just magnify losses, it removes choice. When asset prices drop, those carrying too much debt don't get to decide when to sell. Lenders, margin calls, and payment deadlines decide for them. They're forced to dump whatever they can at whatever price the market will pay. That forced selling pushes prices down even further, creating the very bargains that well-prepared investors are waiting for. On the other side of that equation is liquidity, having cash or low-risk capital available when others don't. During good times, sitting on cash feels slow, boring, even foolish. During bad times, it's a superpower. It means you're not scrambling to survive. You're calmly choosing what to buy. Positioning yourself for the next wealth transfer starts long before the crash. It begins with reducing dangerous debt, avoiding overextension, and deliberately building a reserve. Not a tiny emergency fund, but a meaningful pool of capital that can be deployed when assets go on sale. In a crisis, your fate is determined less by the headlines and more by whether you're over-leveraged or liquid. When markets are booming, almost everything looks like a good investment. Story stocks, speculative projects, meme trades, and fragile business models can all rise together, simply because money is flowing and optimism is high. A crash brutally sorts through that. The first to collapse are the illusions. Companies with shaky finances, no real profitability, or products nobody truly needs. Their prices were built on narrative, not necessity. Once confidence breaks, many never recover. But real value doesn't vanish just because fear spreads. Businesses that provide essentials, energy, utilities, logistics, food, healthcare, core software, critical infrastructure may see their stock prices fall, but their importance to society doesn't disappear. People still flip light switches, buy groceries, seek medical care, move goods, and rely on digital tools. The same is true for high-quality real estate in truly desirable locations. Prices can drop, sometimes sharply, yet the underlying land, access, and usefulness remain. Over time, those fundamentals pull value back upward, especially after weak hands have been flushed out. Your job as an investor isn't to chase everything that moves. It's to develop a clear sense of what will still matter 10 or 20 years from now, and be ready to acquire more of it when temporary panic misprices it. Not every disaster comes with a market crash chart you can point at. Some crises happen more quietly, through a steady erosion of what your money can buy. That's the world of inflation and currency debasement. When policymakers respond to problems with constant stimulus and money creation, they can delay defaults and soften downturns, but they rarely do it for free. The cost is that each unit of currency gradually loses purchasing power. Wages don't keep up. Savings accounts feel safe on the surface, yet their real value shrinks over time. This is another form of wealth transfer. Those who own productive assets, businesses, real estate, commodities, infrastructure, often see nominal prices rise along with or faster than inflation. Those who mainly hold cash, fixed salaries, or long-term bonds quietly lose ground. During periods of stress, this process can accelerate. People wake up to find that the savings they thought would fund decades now barely stretch across a few years. Pensions and fixed income plans built on old assumptions become strained. Preparing for the next reset isn't only about surviving volatility in stock charts. It's about recognizing that your enemy might also be slow, silent, and wearing the mask of stability while it quietly erodes your future. The next major financial event won't treat every country equally. Some economies will experience deep recessions, currency declines, and political strain. Others will struggle but remain relatively stable. A few may even emerge stronger as capital escapes weaker systems in search of safety. For investors, that means one crucial shift: thinking beyond national borders. Relying entirely on one currency, one government, and one economic system concentrates your risk more than you might realize. When domestic debt, politics, or policy mistakes create turmoil, those who hold assets tied to more resilient regions and currencies often fare much better. Owning foreign stocks, funds, businesses, or property can provide a hedge against local instability. So can simply holding part of your savings in stronger currencies or diversified global vehicles instead of everything being tied to a single home market. You don't need to become an international finance expert overnight, but you do need to accept that crises in a hyper-connected world are multi-layered. Capital doesn't just vanish, it moves. If you position yourself intelligently, some of that movement can be toward you instead of away from you. The next reset will be global. Your strategy should be too. On paper, crisis investing looks simple. Build cash, wait for fear, buy quality at discounts. In practice, it's one of the hardest things you'll ever do. When markets are soaring, everyone around you is excited. Friends brag about their gains. Social media celebrates risk takers. Financial media praises new paradigms. In that moment, being cautious feels wrong. You look conservative, fearful, or behind. Then, when the cycle turns and prices plunge, the emotional environment flips. Panic takes over. The same voices that celebrated endless growth start predicting permanent collapse. Your feed fills with doom. People who never cared about economics suddenly swear the system is finished. That's when your instincts betray you. Everything in your body screams, "Get out! Don't buy. Wait until it feels safe again." But by the time it feels safe, the best opportunities are gone. The investors who capitalize on crashes aren't ice-cold robots. They feel fear like everyone else. The difference is that they made a plan when they were calm, and they trust that plan more than they trust their emotions in the moment. Discipline, not genius, decides who ends up owning the assets everyone else sold in terror. You can't control when the next reset happens. You can control how exposed or prepared you'll be when it does. Start by taking a brutally honest snapshot of where you stand. How much of your wealth depends on continued optimism in markets or constant economic growth? How vulnerable are you to job loss, rising rates, or falling asset prices? How much is locked into speculation versus anchored in durable value? Next, design a shift. Reduce toxic debt that could force you into selling at the worst possible time. Build a meaningful cash buffer, not just for emergencies, but for opportunity. Slowly tilt your portfolio toward quality, strong balance sheets, essential products, and real assets that people will still need regardless of economic headlines. Then write your rules. Decide how you'll respond if markets fall 20%, 30%, or 50%. At what levels will you increase buying? Which assets will you refuse to dump during panic? What portion of your wealth will you diversify globally? Finally, invest in yourself, skills, health, relationships. These are the assets that help you adapt, earn, and stay steady while others break. You're not just trying to survive the next crash. You're designing a blueprint to use it. The next major downturn won't ask your permission. It won't arrive on your schedule, and it won't check whether you're emotionally ready. It will simply appear, like every crisis before it, turning confidence into panic and exposing how fragile most financial plans really are. In that moment, two stories will unfold at the same time. One group will see everything they counted on fall apart. Another group will quietly step in, buying the very assets that will drive the next decade of growth. The gap between those stories is being created right now in the choices you make before the storm. You can ignore the patterns, hope this cycle is different, and trust that somehow the system will protect you. Or you can do what the prepared always do. Learn how the game really works. Build liquidity, upgrade the quality of what you own, spread your risk intelligently, and commit to acting with discipline when others are ruled by fear. If you want more content that breaks this down clearly, how to think, where to focus, and how to turn crisis into a catalyst instead of a catastrophe, then don't just scroll away. Stay plugged in, hit subscribe, and start positioning yourself on the side of the next great wealth transfer that wins.